We live, Maggie?
We're live.
We're live. What's going on, guys? Welcome to another Wednesday workshop. My name is Nate Hare. I am the sales director at Nuview Trust Company. And today we are going to talk about lending with self-directed IRAs. I've got some real good content for you guys. First, let me just thank everybody for continuing to support the workshops that we're doing here at Nuview. We've got a lot of great feedback. You guys are really enjoying it. I'll continue to keep putting out content that's relevant to you guys. And if you ever have anything that you want discussed that we haven't covered, shoot me an email or just let us know. And we'd love to cover it. So we're talking today about one of my favorite topics, which is lending. And the reason why I'm passionate about lending is, first, I got my start in real estate working as a loan officer. Right out of college, I got into the financial side of real estate, and I worked as a lender for residential mortgage companies for many, many years. And that's kind of where I got my first taste of lending. I've always been a numbers guy, but I always liked real estate. So through working on the financial side of real estate transactions, I've come to learn about real estate as well. And I've just always had a passion for lending. But nobody ever told me back then when I started that you can lend out of a retirement account. That was a concept that was completely strange to me up until 2012, when I actually first started learning about these self-directed IRAs and just IRAs in general, and really the true power you have with a self-directed IRA and how you can apply lending as a strategy within your retirement account, and why a lot of people gravitate towards that. Not myself, but we have a lot of clients in Nuview that are private lenders with their retirement accounts. But it's always good, before you go into any investment, or if you are currently a lender, it's always good to kind of revisit some things and maybe look at different ways that you can create win-win situations that have to do with capital in an IRA, and people that have investment opportunities. So we're going to talk about a lot of good stuff today, and I encourage you guys to ask questions. If you're joined through Zoom, go ahead and type any questions that you guys have in the Q&A there. I've got my IRA specialist, Alex Sylvia, on board. He'll answer questions as we go along. And if there's any questions left over at the end, I'll tackle those as well. And if you're watching live on Facebook, make sure to comment and engage in the comment section there, and we'll get back to you as soon as the class concludes. So let's just jump right into it. All right. I got to see my PowerPoint, Maggie. All right, there we go. All right. So how to be a private lender with your self-directed IRA. First, as I always start, I always have to have our disclaimer for anybody that's new out there. Nuview Trust Company acts as a custodian for retirement accounts that hold alternative assets. Okay, so we're kind of an alternative option to your Fidelities or Charles Schwab's. We're a custodian. We manage retirement accounts, but the difference between us and those companies is we don't sell investments to our clients. We're not licensed securities brokers. We don't work for commissions. We're just a fee service business that manages retirement accounts. And when we don't sell investments to our clients, it actually gives our clients the broadest spectrum of investment options that they can hold within their IRAs, their ESAs, their HSAs, and their 401ks that they have set up here at Nuview Trust Company. So we are not selling investments. These workshops are to provide you guys great education so that you can pick your own investments and make your own investment decisions that suit you well in your retirement accounts here at Nuview. For anybody that's new, I'm just going to cover some real quick basics, and then we'll jump into the topic of today. But I always get this question: what is a self-directed IRA? Or there's actually a lot of people that are confused about what self-directed really means. IRAs in general are all governed by the same set of rules. So if you have an IRA at Fidelity, that IRA is no different legally than an IRA at Nuview. The reason why we call it self-directed, though, is because you have to pick the investments when you have an account here. But it's not a type of IRA. It's just a marketing term. Most of our clients have IRAs at Fidelity, Charles Schwab's, and they have IRAs at Nuview. Again, those IRAs are no different. It's just the companies are different in what they do and what they allow you to hold within the IRAs you have there. So if you have a Fidelity IRA, you're typically used to holding stocks, bonds, mutual funds, and CDs. But most people don't realize you can hold all sorts of assets outside of those traditional assets. Things like real estate, rental property, land, promissory notes, which we're talking about today. oil and gas interests, cryptocurrency, mineral rights. So there's a whole list of investment options available to you out there. But if you want to invest in things outside of the public market, the things that Fidelity doesn't sell, well, then you have to have an IRA with a company like Nuview so that we can hold and administrate those assets within your retirement account. So what would be the benefit of having a self-directed IRA? Well, one benefit is just diversification. I think it's wise to have IRAs at different custodians because it serves the purpose of true diversification. If you want to hold some stocks and bonds, great, have an IRA at Fidelity. If you want to hold some real estate, some tangible assets, some promissory notes that maybe give you some residual income or some income streams that you like that your stocks don't give you, then have an IRA at Nuview as well. That gives you true diversification with your retirement portfolio versus just trying to diversify with different types of mutual funds. The biggest thing with IRAs, though, and why we're so passionate about talking about this, especially here at Nuview, is the tax savings that it gives you as an individual. So when you're trying to save for retirement or invest your way to retirement, it's important to understand that the money that you hold in your bank account or in your name is always going to be taxed. So it's hard to save, it's hard to retire when you are constantly having to pay tax every year on your earnings, even if it's your investment earnings. IRAs, traditional IRAs, Roth IRAs, SEP IRAs, HSAs, ESAs, which we'll talk about here in a second, they all are tax exempt trusts that you manage, you put money in, but as you invest it, a wonderful thing happens. The taxes are gone. There's no taxation as you buy and sell investments within the accounts we have here at Nuview. So if you're looking to retire earlier or have your profit grow in a completely tax-free manner, it's impossible to do it, nearly impossible to do it with your own money. But if you put money into one of these plans that we have here at Nuview, then you can actually eliminate taxes. And if you play your cards right, eliminate taxes for multiple lifetimes by using these accounts. So tax savings is a great thing that these IRAs give you. But ultimately, what you want to do when you're investing is just invest in what you know best. I would probably argue that if you walk up to the average American and say, do you understand the stock market? Most of them would say no, right? Or they have a financial planner, a wealth advisor that invests for them. But if you walked up to the average person and said, do you understand real estate? Do you understand how a loan works? Do you understand this or that? Most people will say, yeah, I understand that more than I understand the stock market. And that's important because when you're going to be an investor, I think that the best way to invest is just invest in what you know best. Every investment's a risk, but you reduce your risk when you invest in the things that you're knowledgeable about. So I kind of told you about my background earlier is I started in lending. So for me, I understand lending and how that process works. So I'm going to make myself better returns in the long run, investing in that versus just investing in the stock market, which I know less about. So again, just giving you some benefits about self-direction for those of you who do not have accounts. For those of you who do have accounts, you already know these benefits. What are the types of plans that can be self-directed? Now, I'm going to cover these plans just real briefly. I'm not going to go in depth on these plans. If you want to look at some of our more basic classes where I go in depth on these, go to our education resource page, our YouTube page. I go over these in depth. For the purposes of this class, I just want to identify the types of plans that you can use to lend, okay? And at the same time, when you're looking at these plans, you want to think to yourself, how many of these plans can I have? Because all of these are tax exempt trusts that gets Uncle Sam out of the equation. You increase your buying power or your investment power by utilizing multiple accounts. So a lot of people might just have a traditional IRA or a Roth IRA, and that's fine. But you also want to think, what are some other plans that I can set up for myself that can be invested in the same things I'm investing in with my Roth or the same things I'm investing in with my traditional, but give me different tax benefits. So first plans are the personal plans that can be self-directed and you can loan out of, which would be your traditional IRA and your Roth IRA. This is where 70% of America's wealth is in these personal plans. Okay? Most people have traditional IRAs from old employer plans that got rolled into a traditional IRA. So if you had a old 401k or an old 403b, or maybe you've got a 401k right now and you might be leaving your job soon. When you leave your employer, those 401ks roll into traditional IRAs. So more people have money in traditional IRAs than Roth, but I would make an argument that the Roth IRA could be much more powerful depending on your investment strategy. And we'll talk a little bit more about that as we go through the class, because I think lending is one of these strategies that a Roth IRA can really play a big role, a key role to creating generational wealth by setting Roth IRAs up and having them be a private lender. So personal plans can be self-directed. You can also self-direct and lend out of SEP IRAs, simple IRAs, or 401ks, and we have solo 401ks here at Nuview. Now, these are strictly for people who have self-employment income. So if you're a 1099, Schedule C, contract worker, you work for yourself, you're a realtor, you're a CPA, you might have an employer plan that's set up for yourself. These can also be self-directed and also partake in being a lender. You can also have items on each page of the menu, I like to say. So if you're an individual that's self-employed, you can have a traditional land or Roth IRA from the previous page. You can also have a plan here. And you can also have what I always say, would you like dessert with that? Specialty plans can be self-directed, which would be your health savings accounts and your education savings accounts for your kids. Now, these are not IRAs. These are actually plans that can still be self-directed, and they're still a tax shelter, but they're a tax shelter to pay for specific expenses with tax-free dollars. So the health savings account, if you utilize it right, you can self-direct it just like you self-directed traditional or Roth, but you could take the profit out immediately, tax-free and penalty-free, to pay for qualified out-of-pocket health expenses. So things like doctor's visits, co-pays, acupuncture, holistic medicine, eyeglasses, vision, dental, all the things that you're probably reaching in your back pocket for, paying with your most expensive bucket of money, your taxable dollars. Switch your mindset as an investor and think, how can I pay for my health expenses for me and my family with tax-free dollars instead? So the health savings account is a vehicle that allows you to do that and can be self-directed. And then Coverdell education savings accounts are great accounts that you can set up for your kids or your grandkids that can also be self-directed. But the benefit is to that child that the account is set up for, and specifically for education expenses. So you can put money in a Coverdell education account for, say, your son or your daughter. You can invest that account and take the profit out completely tax-free and penalty-free to pay for qualified education expenses for that child. And those are education expenses that start from kindergarten all the way through college. So tuition, uniforms, books, iPads, computers, your home internet bill is actually a qualified education expense that can be paid with tax-free dollars. So when we talk about self-directed IRAs and retirement accounts, we're not just talking about retirement accounts. We're actually talking about accounts that can actually be utilized and invested today and cover today's expenses when it comes to healthcare and education. So I'll get off my soapbox there. I just want to cover a little bit of the plans. But again, when you look at these plans, if you're going to be a lender or you're going to be an investor, it's good to get multiple plans going at the same time, right? Because your retirement plans have different tax benefits than your HSA and your Coverdells, but they can all participate in the same investment. And it's actually very easy to do that when you're a lender. And one of my first case studies, I'll show you how I partnered 4 different IRAs together, one of them being an HSA, on one note to one investor and how that played out. So moving right along. What are some restrictions on IRAs? And I want to touch on this real briefly because there are some restrictions when it comes to your IRAs. And this is universal. This is not just a Nuview restriction. This is not a self-directed restriction. This is an IRA restriction. The reason why you don't normally hear these restrictions from your guys at Fidelity or Charles Schwab is because they're only buying and selling investments from Wall Street. When you are buying and selling investments privately, like self-directed investors do, well, then you do have to understand these rules, because not understanding them could get you into some hot water. And when we're talking about lending, we have to be really, really careful about doing something that would be considered prohibited. Okay. Now, when we're talking about prohibited transactions and what's restricted with your IRA investments, the most important part about this topic is the people restrictions. Okay. The people restrictions are a list of people that are considered disqualified to the IRA or plan. Okay. The disqualified people are people that are considered fiduciaries of the plan. So for instance, I'm a fiduciary to my Roth IRA. What that means is I have a job to my Roth IRA to find it investments, to make it grow, because it's not going to grow on its own. But my benefit from that Roth IRA comes from the distributions I take from that Roth IRA or traditional IRA or SEP IRA. But as the fiduciary, I make the decisions for it, but I can't make decisions for my IRA's investment that self-benefit me. For example, if we're talking about lending, I can't tell my Roth IRA to make a loan to me. I could probably strike up some pretty fancy deals dealing with myself, couldn't I? But since I'm the fiduciary of the IRA, that's me acting in the best interest of me, not the best interest of my IRA. So you have to be very careful about who your IRA can loan to and who can borrow from your IRA. The people that cannot take loans from the IRA are the IRA owner and the other fiduciaries, which I'll name here in a minute. Okay, and the list is really short. Okay, and it doesn't get many people, but it's basically close family members. Remember, you and your IRA are two separate people. Call it Mr. IRA or Mrs. IRA. Your IRA is a separate entity. Your job is to make it grow, and you take benefit from distributions. But you're still separate people, and you can't be on opposite ends of the fence when it comes to an investment. So if you're looking at this graphic here, if I was to make a loan to my IRA, that would be prohibited. Okay, because me and my IRA are on two opposite ends of the fence when it comes to that investment. I also can't take a loan from my IRA, two opposite ends of the fence. But if I put myself on the same side of the fence, let's say I had $50,000 personally, and I had $50,000 in my Roth IRA. Could me and my Roth IRA partner together, same side of the fence, and make a loan to Alex? You can't see Alex over here, but Alex is not a disqualified person to me. Okay, he's not my spouse. He's not my child. Well, I don't know about that. That can be art. No, I'm just kidding. He's not my child. He's not my parent. We're just making jokes here. But since me and IRA are on the same side of the fence, that's different. That's partnering. Okay, so just make that distinguished. Partnering is when me and my IRA are on the same side of the fence. If I put my IRA on the opposite end of the fence, it's probably something that's prohibited. The other people that are equally disqualified to my IRA as me are all these people. You guys just let me know when you memorize the list, and then I'll move on. Got it, Maggie? All right, let me simplify this list. I don't think that you guys want to memorize this list, but let me just simplify the list so you just understand who is disqualified to an IRA. Who can your IRA not make loans to? It starts with myself, the IRA owner, my spouse, any lineal ascendants or descendants. So that'd be parents, grandparents, all the way up, kids, grandkids, all the way down, and their spouses, and any companies those same people own, control, manage, or are highly compensated by. I'm giving you kind of the cliff notes of how to interpret this chart. Me, spouse, up the line, down the line, their spouses, and any companies those people own, control, or manage. Now, what that merely means is that my IRA cannot make a loan to my spouse. My IRA can't make a loan to my son or my parents. And the reason why they disqualify those people is those are the people that are usually in the line of inheritance, right? If I pass away, where are my IRA assets going to go? My spouse, if I'm married, or usually my kids or my grandkids. So, and that usually passes on in the form of an inherited IRA. So it would be pretty awkward if I made a loan from my IRA to my son, and then I passed away, and then he had an IRA, an inherited IRA with a loan to himself. So you can see why they disqualify those people, lineage and spouses, though they're all considered fiduciaries because most likely they'll inherit the assets at my passing. But that brings the question up. What about brothers, sisters, aunts, uncles, cousins, nieces, nephews? In the IRS rules, those are not considered disqualified people. Okay. Now there's another question. Do you want to make a loan to your sister? Do you want to make a loan to your brother? Is that going to be weird? And we have some considerations where I'll kind of touch on that, but family to the side is not considered prohibited. Okay. Now there are some exceptions though. For instance, my brother is the beneficiary of my IRA because I'm not married. So he is the beneficiary. So mere fact of me putting him as the beneficiary, even though he's my brother, he actually is a disqualified person to my IRA. So there are some exceptions to the rule. And I will just tell you guys, you don't have to be experts on this. Just give us a call. If you've got a question or a scenario and you want to make sure that it's not prohibited, just give us a call or shoot us an email. And I'll give you our contact information here at the end. But just remember the people your IRA cannot make loans to, very, very important. And there's so many other people you can make loans to. So that usually doesn't get people. The things that those people can't do, you can't buy anything from your IRA, sell anything, trade, loan, which we're talking about today, or extend services. I'm going to just keep this brief and we're just going to talk about lending. And then here's just the investment restrictions. These are the only two things that cannot be held in an IRA, which is life insurance contracts and collectibles. So if you have an advisor or somebody that says, no, you can't hold real estate in an IRA, well, they don't understand the rules, or they're just talking about the IRA at their company. Right? A Fidelity IRA is not going to allow you to hold a promissory note because they don't sell promissory notes. But promissory notes and real estate and all the alternative assets that we hold here are allowable investments. These are the only two that are not allowed based on IRS rules. All right, moving right along. So investment choices, for those of you who are new, here's some of the common investment choices we see our clients make. We see some of our clients make real estate purchases. They find them a variety of different ways. We see clients invest in private entities, trusts, partnerships, LLCs, joint ventures, again, LLCs of non-disqualified people. Oftentimes those LLCs own real estate within them, even joint ventures and partnerships, same thing. But we're going to stick to the topic here and talk about loans. Okay, we're going to talk about notes. Now, here's two most common notes that we see within retirement accounts. Secured notes, number one, and then we also see some unsecured notes every once in a while. There are some other ones that we'll talk about too. You can throw in net profit notes, you can throw in convertible notes, and I'll talk a little bit about these on the next slides, but these would be the most common. Secured notes just means it's a note secured by property or secured by something. It doesn't have to be property. I've seen a note secured by a tractor before. That was definitely in Texas. Unsecured notes means it's just a note that's not secured by anything. Okay, so those are the two most common investment options. But before you decide that you want to own a note or be a lender, in this case, there are some considerations you want to make. So we'll talk about the bad stuff and then we'll move and we'll talk about the good stuff. So the first thing is, I get this question a lot is, okay, Nate, well, what happens if the borrower doesn't pay me? So first you got to ask yourself the question, is it a secured note or an unsecured note? Okay? If it's an unsecured note and the borrower doesn't pay you, well, you're going to be forced to go through court and sue them and things like that. So most times you're going to want to stick to secured promissory notes because there's collateral, which is typically the property. Most people are making loans out of their IRA to a, say, real estate investor who's using that money to buy property, and your money is secured by the property if you do it right. But if you are secured by the property, you also want to understand what happens if the borrower doesn't pay you. Now, this comes down to foreclosure laws, and every state is different. Some states are judicial states. Some states are non-judicial states. If you're in the state of Florida, we are a judicial state. So I just put some kind of questions here when you're looking up foreclosure laws, because I'm not licensed to teach you guys your foreclosure laws in every state. I'm familiar with Texas, I'm familiar with Florida, and I put in parentheses the answers to these questions for Florida. But you just want to find out the process in general of what the foreclosure process is in the event your borrower doesn't pay you back. Okay, it's not a bad thing. And one thing I will mention too is foreclosure is not a bad thing. It's just something that you have to understand and be prepared for in the event your borrower doesn't pay. Now, I'll tell you, in my career, most of the loans I see go into default are not because the borrower just decided that they're going to run away with someone's money. Okay, that's a bad thing. But you, as a lender, even if you trust the person, you got to make sure that, what if the person dies? What if the person gets ill? You know, what if they just overextend themselves? That's usually the time where a note goes into default, is somebody just overextended themselves, somebody got ill, got sick. It could be a variety of different reasons, but you always just want to understand the foreclosure process on the house that you're secured by, where that house is, what state it's located in, and how the process works. Some states take a little bit longer in their foreclosure process. Some states are very quick. Okay. Why do you want to analyze that and find out what the time frame is? Because again, in the worst case scenario, how long is your money going to be tied up? Okay. Holding costs are something you want to take into effect when it comes to your overall rate of return, right? If your borrower is not paying you and you also have to wait an extended period of time before you can take the property back through foreclosure, then again, that's eating away at the time that you can be reinvesting that money and so forth. So these are just some questions that I put up here. Is your state a judicial foreclosure state? Is it a non-judicial foreclosure state? What document secures your money to the property? Is it a mortgage state or is it a deed of trust state? What's the average timeline for foreclosure? Sometimes some states, the timeline on foreclosure for investment property is faster than owner occupied property. I will tell you, most of our clients are making loans on investor property, investment property. So there are some differences with rules. Sometimes lenders can take property back faster than investment property. But if you're making loans on owner occupied property, which I can't give investment advice, but I would strongly consider maybe not doing that because you fall into Dodd-Frank laws and all sorts of things. So again, you want to understand what's the worst case scenario. If my borrower doesn't pay me, what type of time frame am I looking at, and what's the process to get this either property back or get my money back? So that's all I'm going to say on foreclosure. Again, make sure that you understand your state's foreclosure laws, and also get an attorney. Get an attorney that can, when you're drafting your promissory notes, which I'm going to talk about the process here, make sure that it's an attorney that understands these rules too, so they can kind of walk you through the process. What are some other considerations to make before being a lender? Now, these are just some considerations. Now, this is not things that you have to do every single time. Everybody has the ability to make their own decisions. That's the beauty part about self-directed IRAs. You get to make all the investment decisions, but you also know who to blame if it goes bad, right? So here's just some considerations that you might want to make prior to getting involved in a loan to a borrower, real estate investor, or whatnot. Number one, don't loan on something you wouldn't be excited to own. That sounds pretty basic, but I'll tell you, I see this rule broken a lot. Now, what that means is in the event of foreclosure, if you take that property back because the borrower didn't pay, are you excited to own that? Okay. I would say most people are excited to own a 3-bedroom, 2-bath house, 2-bedroom, 1-bath house. They know what to do with that, right? If you take that back in foreclosure, you can either sell it or rent it, and you have that asset generating income to yourself. But are you going to be comfortable making a loan on commercial property? Do you know what to do with commercial property in the event of foreclosure? Do you know what to do with an apartment building or multifamily property? So make sure that you understand what it is that your money's tied to, and make sure you would be excited to own that in the event that the borrower goes into default. So that's the number one. Number two, hire professionals to help you evaluate your deals. Now, there's a couple different things that you want to have professionals to help you evaluate your deals, especially if you're new. One is when you're doing a loan to a borrower, first, you've got due diligence. You've got two sets of due diligence, really. You have due diligence that you want to do on the borrower themselves. Make sure you understand their track record. Make sure there's no, fraud reports out on them. You make sure you trust the individual first. But then you also want to do some due diligence on the property that your money is going to be tied to, right? And that might, involve running some comps. Okay. Now, if you don't know how to run comps, find somebody that does, right? Be friends with a local real estate agent who's got access to MLS who can run comps. Be friends with somebody that's a lender maybe that can run comps. So hire professionals or have some people in your network that can help you evaluate the deals, evaluate that the property is a good property to be secured by. And also when you're drafting the documents needed to own a note, one is going to be the promissory note. Make sure that you get an attorney to draft that for you. Okay. So again, hire professionals to help you evaluate your deals, especially if you're new. It will save you in the long run, trust me. Number three, when you structure the terms of your note. Now, let me just back up just for a second here. When you structure the terms of your note, when you're a lender, when you're a private lender, you can get really creative with the terms, which is something that I actually really like. Outside of the banking world where it's all pretty, cut and dry, private lending, you get real creative. And I've got some creative strategies here at the end here, so stick with me. But when you get creative, you draft the terms of the note. Between you and the borrower, you guys decide how long the loan is for, how much you're loaning, when payments are to be made. Are they made monthly? Are they made quarterly? Are they made annually? Are they made all at the end when the loan matures? You decide all of that. In that process, though, think about how much teeth do you have to change things? And what I mean by that is if you structure a loan and you're not asking for monthly payments, okay, it's going to be hard to call that loan in default because you're not requiring the borrower to make payments. And even if you know that borrower is in trouble, And I've seen this done where people make a 2-year note and all the interest and principal is due at the end of 2 years. Okay, well, that's great. Might be a good deal, but what happens between day 1 and year 2? What happens if the borrower gets in trouble? Well, you haven't specified in the note that they have to pay interest payments monthly. So how do you call that loan in default? So one of the things in your notes is make sure you collect monthly interest, right? Not as a way to get cash into the account, as a way to gauge whether or not the borrower is performing or not. Okay. Now you can be creative with this. If I'm loaning to a real estate investor who's flipping a property. Now I know that a flipper is not making any money until they finish the rehab and they sell the property, which could be 6 months, down the road. So in my evaluation of doing a loan to a borrower who's flipping a property, I don't want to make it so hard on them that they have a hard time managing the deal because they have to make me monthly payments starting right off. So maybe I'll negotiate something if I trust their job, trust them and trust their work. Maybe I give them 3 months, no interest, or 6 months, no interest. But I'm not going to go much longer past that without putting monthly payments in there so I can gauge whether or not he's performing or not. So again, you can get creative as you want, but just think about that when you're structuring your notes. If the loan goes into default, take action immediately. Now, most foreclosure process, it's a process. It's not like you just take the house back when they stop paying. You have to send a notice of default. You've got to wait an amount of time. You send an acceleration of the notice, or depending on the state, there's going to be different steps in the process to foreclosure. So once the borrower, if they miss a payment, send a notice of default right away. Or take whatever the first step is in the process, because with foreclosure, you can't finish a foreclosure unless you started one. So there's a process usually that has to start, but just take action immediately. Don't wait. A lot of times, if your borrower misses a payment, you send a notice of default, that payment comes in the very next day. But if you don't send a notice of default, what are the chances that they're going to pay? Who knows? Number 5, be careful how much your IRA fronts for the rehab, for big rehab projects. Now, when you're structuring a loan to a borrower and they're going to flip a property, and let's say the rehab is extensive. Okay, let's say it's a $70,000 property, or to acquire it $70,000, and it's $30,000 to rehab it, and the ARV is $130,000. Now, if I loan all $70,000 out of my IRA to the borrower and all $30,000 to rehab it, okay, I'm out $100,000. $100,000 is out of my IRA and it's in the hands of that investor. What happens if they die the next day? What happens if they get in a car wreck the next day? What happens if they get sick the next day? Well, if I end up having to take that property back, well, I still out $100,000. I can't get that back in some cases. So if I take the property back and the rehab's not done, well, what do I have to do to get it sold? I'm probably going to have to put $30,000 more to rehab it. So how do I prevent problems like that? Just do incremental fundings. Fund enough to get the property acquired, and then figure out with your borrower, how much is it going to take to get the first set of repairs done? Is it 5,000? Is it 10,000? Just send that amount first. Send that amount. After that's done, have the borrower send you evidence that the rehab's done. Send pictures. Maybe if it's in your area, drive by and take a look at it. One of the great things I like about lending too is if you're interested in investing in real estate, but you're worried about learning or having somebody teach you, be a lender to somebody that's got experience. That's a great way to get free coaching, I'd like to say. You're making money on the deal by being the lender, and most times a borrower is going to allow you to be around the project and at least check it out, so you get some learning lessons along the way on how to actually be a home buyer. So, but when it comes to fronting money for the rehab, just be careful on how much you front all up front. Now, you can do this several different ways. If it's a Nuview account, it's really easy to just send incremental payments. You tell us. Basically, we don't do anything unless you tell us to do it. So if you tell us to fund the note, we'll fund the note. If you tell us to send 10 grand for the first set of repairs, we'll send 10 grand for the first set of repairs. So you can do that through us. Or I've seen people just put the 30 grand in an escrow account. A third party holds it, and you tell that escrow individual or the people managing that third party account when the next set of repairs goes out. But again, just be careful how much you front all up front without actually seeing some of the work being done. Okay. Number 6, oops, sorry, I got a little trigger happy there. Number 6, get title insurance on your loan. Now, all these here, this is everything that a bank would do. So if you're going to use your IRA like a bank, just think like a bank, okay? Banks are going to require that you get title insurance, right? Banks are going to require that you close at a title company or with an attorney. That should be no different than you using your IRA as the bank. Okay. No Starbucks closings, right? Make sure you've got clear title to the property and make sure that there's insurance for that clear title through a title company. Okay. Number 7, make sure your IRA is listed as the lender on any insurance policies. Okay. When a person buys a house, they get homeowners insurance. If there's a lender on that property, they list the lender as the mortgagee or the on the insurance policy. What that does is that if the house says burns down, you're going to get a check as the lender, making yourself whole. But if you don't make sure that your IRA is listed as the lender on the insurance policy, well, then you're going to be contacting the borrower, make sure they endorse that check back over to you. Just don't even get into that issue. Make sure your IRA is listed as the mortgagee on the insurance policy. And just what banks do. Number 8, make sure property taxes are paid. If you're the lender on a property, make sure that property taxes are being paid. Either have the borrower show evidence that the property taxes are paid and current, or just go online, go to the county assessor's page and make sure that they're current. But that's one thing that might bite you in the butt. If your borrower's paying on time, you might think, oh, this loan's going great. But if property taxes aren't being paid, county assessor might come in and surprise both you guys. So again, just take a little bit of time. It's very easy to make sure property taxes are paid. Definitely make sure property taxes are paid if your money is secured by the property that we're talking about. Number 9, if you're loaning to an entity, okay, if you're loaning to someone's LLC, ask for a personal guarantee, okay? Now, I would say sometimes people don't do this all the time, but remember, if it's the house is in an LLC and that LLC, the investment goes bad, well, you might have a little less security or recourse to go after any assets if it's within an LLC. So if you're loaning to an entity, ask the managing member or the person that's managing that entity, ask them to sign a personal guarantee if they're willing to do that. And number 10, do not loan to anyone you would feel uncomfortable foreclosing on. So this goes to brothers, sisters, aunts, uncles, cousins, nieces, nephews. I've seen it so many times, more times than I'd like to admit, somebody using their IRA and loaning to like a boyfriend or a girlfriend, and then they break up and then things get weird, or it's just to a family member that ends up not being able to pay them back. Well, if you're going to do a loan, okay, make sure that you're comfortable foreclosing on that individual and that they understand that they'll be foreclosed on. So do you want to loan to your uncle and then have to foreclose on him and then have to sit in November at Thanksgiving dinner across the table from him? I don't know. Some people think that that's totally fine, but just think about that before you do a loan. Make sure that you're treating it, you know, as a good investment for your IRA and that you're not going to feel uncomfortable foreclosing if things go sour. So let's look at some case studies here. So this is an actual case study. Okay, one of my own, of a real estate investor that needed $105,000 to buy a property and met this individual. He had been around at some of our events and was a good real estate investor. I've seen some of his work, and this is how also when you're a borrower, this is how you find private capital, is to attend events where people might have IRAs. Guess where there's some events that you might find a lot of people with self-directed IRAs? Yeah, Nuview Trust Company, we've got events. And we've got some events coming up, which I'll talk about. So if you're a borrower looking for private capital, again, this is how I met this individual. He was coming to our classes and I met him and he walked up and he said, hey, Nate, I've got a deal. Wanted to see if you're interested on this deal. So the reason why he came to me is because he needed to close fast. Okay. He had already tried to get financing through a bank. They didn't like the property for whatever reason, but they also couldn't close in the amount of time that he needed to close because he found this off-market deal. He found that the owner of the property had inherited the property, had never even seen the property. This property was a mess. Grass was overgrown, the concrete was all whacked out, and it was the property that parents tell their kids not to play in. So that was this type of property. So conventional banks weren't willing to loan on it. And he wanted to close fast before somebody else picked up on this deal. So came to me, and what we did is we actually structured it to where 4 IRAs partnered on one loan to this individual. Now, the reason I want to mention that is because most of the loans that we see here are considered split assets, are multiple IRAs on one promissory note. Now, that doesn't make 4 liens or however many IRAs there are. When you look at the note, okay, the note is going to list the lenders. And if the lender is an IRA, there's going to be a vesting to your IRA. Typically, it's Nuview Trust Company, FBO stands for the benefit of your Roth IRA and account number. Okay. If you want to partner your wife's Roth IRA, it would say this the same thing. If you want to partner your HSA, it would say Nuview Trust Company, FBO, your name and HSA. And in parentheses next to each one of those names would be their pro rata interest of the investment. And this is based on how much each of those accounts puts into the deal. It's very easy to structure it that way. It's not a lot of work. It's just putting more names on the promissory note. It's not individual liens. It's not nothing other than just a fractionalized note with different lenders who own a piece of that note. Some people say, well, is that running a syndication? No, this person was not coming in raising money from different individuals. He came to me and I partnered with 4 IRAs of people that I knew. Okay, so that's not a syndication. That's just a private money loan. And I brought the money to the table through 4 different IRAs. So here's kind of how this worked. The deal was good, right? He needed $105,000. The ARV was 155, 170. He actually told me it was 155 when I ran the comps, or actually ran it through a friend. He came back and said it was 170. So I thought that's a great deal for me as a lender to be secured by, because there's a lot of equity in that property in the event that things go bad. So again, this is an example of foreclosure is not necessarily a bad thing. If he didn't perform on this note, I get a property that's got $50,000 of equity in it, and I can probably figure out what to do with that. And obviously that makes him he's going to make sure he makes those payments because he doesn't want to lose out on that equity either. So we structured it. We just negotiated terms. He was fine paying 2 points up front and 12% interest. Okay. And those 2 points and 12% were all split pro rata amongst the 4 IRAs. How we structured the note, it was a 1-year note with a balloon, okay, which means it was amortized over 30 years as if he was making payments over 30, but the entire balance is due after year 1. And we also had a clause for an optional extension if he was on time and he wanted to continue the loan, say it for another year. So again, these are just options you can put in there. Optional extensions sometimes come with a fee. If my borrower wants to extend for another year, he might have to pay a point, but maybe that's good for both of us. The reason why we have a balloon is because, and again, everybody's different. I want my principal back after year 1. Why? I don't like to be involved in long-term deals because my money's tied up for longer than I like. I like to be able to get my principal and interest back in a year and then reinvest all the interest in the next deal. Why? Because now I'm compounding my interest. If I lock myself into a longer term loan, I don't get to compound interest. So I like to do short-term notes. And the reality is borrowers like this don't want to be tied to me as a lender at 12% for much longer than a year. So his whole game plan was use private money through IRAs that we had as the way to acquire the property. Okay, there was plenty of equity in it. So it's just the cost of doing business to him. We closed in 4 days. And then what he did is after a year, he just refinanced. Once it was all rehabbed, he refinanced to conventional financing with his local lender. So we got paid back our principal and interest. We went on to do other deals. And then he got to keep that property with conventional financing and turned it into a rental property. Now, another thing that you do too, and which another reason why I like loans, especially with IRAs, is that there's some cost to doing it, right? There's some administrative costs, to holding an asset in a self-directed IRA, to processing an investment. It's not a lot, maybe a couple $100, depending on how the size of the deal. Who do you think pays those fees? Not me, the borrowers do. When you're a lender, you can have your borrowers pay the Nuview fees. Why would they not want to pay the Nuview fees? If they go to a bank, they have to pay fees, and the fees at a bank, I'm telling you, are way, way more than your couple $100 that you pay at Nuview. So one of the things that I like about being a lender is that I don't have to pay the fees because my borrower always pays the fees. So that's a good way to basically know exactly what you're earning, your rate of return is, and you don't have to minus out fees, right? We made exactly 14% for the year, straight across the board, right? We don't have to do any fancy math. And he was perfectly happy paying those fees because it was a lot less than he would have had to pay going through a hard money lender or something like that. Okay. Now, how's the process work for those of you who have not done this before? What would a client do if they had a self-directed IRA set up here at Nuview? And how would they process that investment? So first, you have to set up an account, right? Set up a Roth for your spouse, set up ESAs for your kids, set up an HSA, whatever it is. Get those accounts set up prior to doing any investment. And also make sure that you get those accounts funded, right? You fund it with a transfer from another IRA, you roll over your old 401k, talk to one of my IRA specialists, they can get you set up and get the accounts funded. Once you've got the money ready in your IRA, then you're locked and loaded and ready to go. Once you find the investor that you're going to make a loan to, here's how you process the investment. One, each client just fills out what's called our note purchase packet. This is how Nuview clients give us the instructions to make the investment, okay? It's not like pushing a button and buying a stock, because there's no button to push to buy a note. We just fill out a purchase packet, and it's really self-explanatory. How much is the loan for? Who's it to? What are the wiring instructions, right? Really self-explanatory, but that's you giving us the authority to send your money to the title company and make the investment of the note. With the purchase packet, we always need a copy of the agreement. So we always need the purchase packet and then the agreement. The cool thing with notes is the agreement is the promissory note. If you're closing at a title company, we just need a copy of the note. So it's very, very quick and painless, because all you need to do is fill out the purchase packet and get the note drafted. Now, if you've got an attorney lined up, you can get that note drafted in a day or two. This is good for you borrowers if you're looking for quick money to pick up properties with basically cash offers. You can get money out of an IRA very, very fast if you've got the account set up and you follow these simple steps. And on the note, when you draft the note, list each IRA with their pro rata interest and make sure that it's vested properly. I've got an example of a vesting of an IRA that would be held here at Nuview, but the vesting of the lender, if your IRA is here, it's Nuview Trust Company. FBO stands for the benefit of, your name, IRA account number, right? That's it. If you've got multiple accounts, you just put that multiple times, okay? That's the actual lender. Remember, you're not lending your money. The money's coming out of your IRA. Once you've got the note to us and the vestings look proper and you submit the note purchase packet, we ask that you just approve all closing documents and tell us when you want the funds wired to the title company or to the attorney's office. And then what we hold as evidence of the investment is we hold either the deed of trust or the mortgage, right? Any closing documents would be held here in Nuview, and that's evidence of your investment. So just like Fidelity holds evidence of your stock by holding stock certificates, we hold evidence of your notes by holding a copy of the note and any recordable documents, deed of trust, mortgages, and whatnot. That's your evidence of your investment. Those are that's the paperwork that we hold. So you're just doing the legwork, we're sending the money, and everything's owned in the name of your IRA. Key points to remember: you can't loan money to yourself or any other disqualified person. You and the borrower are free to set your own loan terms. So we're going to talk about some other creative ways to structure win-win situations here coming up. And then IRAs can loan money unsecured or secured by other assets other than real estate, such as equipment or mobile homes. So as long as you have a security agreement that says if the loan goes into default, my IRA gets this, okay, that's considered technically a secured loan. Most people are doing secured loans secured by real estate. So let's talk about some other ways that you can create win-win scenarios. What I've just discussed is really just a simple interest loan. That's the most basic common loan that we see. The loan is going to be for this amount of time. The loan is going to be for this amount. These are the lenders, and the interest is paid at this interest rate. But there's other ways to create win-win scenarios when you're talking about an IRA being used as the capital source and somebody, a borrower or a real estate investor, being the sweat equity piece. Okay. Now, again, this is real important for people who are looking to borrow money, because you want to come, if you're going to approach somebody that's got an IRA and you've got an investment you're looking to be funded, you don't want to come in with one option on your menu. You want to come in with multiple options, because every person is going to want something different out of the deal, and you can structure different deals to fit different needs. So another common way that people create win-win scenarios where IRAs are the capital source and somebody else is doing sweat equity is through a joint venture. Now, joint venture, there's pros and cons to each of these, by the way. Okay, let me back up just a second. Simple interest loan. What are the pros to it? It's simple, right? What are the cons to it? Well, you're not in control of the investment. You're a lender, so you have to understand that. The borrower still has all control of the investment. You don't get to dictate when the property's sold. You're just the lender. A lot of people liked it like that. It's simple. No toilets, no tenants. When you have a joint venture, it's different, because it's not a lender-borrower situation. You're partners, okay? On a joint venture agreement, a joint venture says, here's where the capital is coming from, and here's who's doing the sweat equity. And when we're done with the investment, here's how we split the profits, or here's how we split the profits going forward. But you're partners, okay? So what are the pros to this? The pros to it, they're relatively easy to set up. Another pro to a joint venture is you can exceed, in some cases, remember, if you're structuring your deal right, the joint venture right, let's just say, for instance, the joint venture agreement states that the sweat equity partner gets 50% of the profit and your IRA gets 50% of the profit. Well, now your IRA is associated with the risk. So that can go two different directions. It could go really well and your IRA can make a lot more money than it could have just charging interest. But if the investment's bad, then it could go the other way too, right? Some joint venture agreements I've seen is they split profit 50-50. Well, if the investment's not making profit, what's your IRA getting? It's 50, what's 50% of zero? Well, it's zero. So just understand that joint ventures can be it could be a creative option. You can make a lot more money having your IRA as the capital source in a joint venture. But you're a partner now. Okay, you can't, there's no borrower lender situation. You can't call a loan due if the investment's going bad. You got to work through with that person, your sweat equity partner, as a partner. And there's no security with that investment. Now you can add some security too, but most joint ventures, you're not going to be secured like you would with a mortgage or a deed of trust. But again, it's good. It's a good way to set up. I've seen a lot of people do very well with joint venture agreements. Other ways, there's other creative notes, convertible notes or net profit notes. Convertible notes, you see it oftentimes if you're loaning to a business. We're not really talking about that today, but you could structure notes to where your IRA is the lender. The IRA gets interest, but as a part of that note, you have the option to convert that note to shares of the company. So you see this, pretty often with if you're making a loan to maybe a startup company or something like that. Again, it's really cool when you get into this private money stuff because you can create different notes and different things to create win-win scenarios. But a convertible note is another way to go other than simple interest note. And then shared appreciation loans is kind of a matrix of all of them. I have an example of a shared appreciation loan of why that would make sense. But basically, it's just like it states there. It's a loan, so you're still a lender. Your IRA is still in the lender's position, so you still have that security where if the loan's in default, you can call that loan due, or you can start with the foreclosure process. But in the terms of the note, there's an equity kicker. Now, some people might say, "Why the heck would the borrower give my IRA equity?" There are certain situations that you might not have thought about that make sense for the borrower to give up some of the equity on his deal. And that's called a shared appreciation loan. Let's take a look at a real life example of how this would work. So this is a borrower that was buying, but first the borrower was buying a mobile home, okay? Double wide mobile home, and $50,000 might sound like a lot for the mobile home. The price was not the mobile home. The price was the land that it sat on. It sat on 2 acres of land. Now this is outside of Fort Worth, Texas, many years ago. There wasn't much around it, but it was a great, it was located in a great area. And why I say that is because the way population was moving at that time, you can tell in 5 years, this was going to be a hot area, right? The city's growing outwards, and this is kind of at the outskirts there. And the investor that found it negotiated a pretty good price, but it wasn't something that he can rent. It's not a property that he was fixing and flipping. It wasn't a property that he was going to, be able to rent because it was way out in the sticks, and he can maybe rent it in the spring and the summertime. Had a nice little pond and things like that, but it was just a good deal to hold on to. So the other reason why he needed private money for this too is because banks are very cautious. Traditional banks are cautious about loaning on mobile homes, right? So he was looking for some private money, and he went to his normal private lender and said, "Hey, I got this great property. I kind of want to hold it, for about 5 years because I think there's going to be some good appreciation potentially down the road." And they started, working up the numbers, and usually they had done loans with each other where the lender, the IRA, would charge 12% and 2 points. On this deal, it didn't make sense, okay? Because it would have put the borrower in the red trying to hold the property while paying 12% on an annual basis, right? So they almost walked away from the deal. They almost said, "Okay, well, it's not going to work out. I just don't think I can get the financing for it. My traditional bank won't do it. The cost of private money is just going to be too high. And I don't want to be in the red and fork out a bunch of money in negative rent for the next 5 years." So the borrower, or the lender, actually said, "Well, hold on 1 second. I mean, I kind of like the property too. Why don't we just look at this in a different way? Why don't we just structure it to where maybe there's less of a pain of a payment and figure it out how we can maybe make some compensating factors in the note?" And what they agreed to do is do a shared appreciation note. Now, when they backed into this, what they did is first the lender said to the borrower, what do you think you can get in rents? Well, how much do you think you can get in rents on an annual basis? Let's calculate that. And what would that equate as an interest rate? So they didn't just guess at 6%. They said at 6%, the borrower could collect enough rents through the year to make that payment and not be in the red. He can break even right at 6%. So great. So we'll drop the interest rate to 6% instead of 12. Since we're going to be in this longer term, since we're both holding this for appreciation, there was no origination fee. It didn't make sense to charge a bunch of money up front, because now what they're doing is since they're putting the lender in an equity piece, he's still not an owner, but now you're in the investment long term. Does that make sense? You're not waiting for this investment to be flipped. You're waiting for the equity to build up too, because what they agreed, since they dropped the interest rate from 12 to 6, dropped the points from 2 to 0, as a terms of the note, they agreed to split the appreciation or split the profit 50-50 when they sell. Okay. Now, fast forward in time. Okay. They ended up going through this loan. The rents for the 7 years that he held the property, the borrower, was exactly enough to cover the payment. So he paid nothing to acquire the property, okay, and nothing through the years because the rents covered the mortgage payments. When they sold the property upwards of $130,000. Again, the land was the value piece on this. They were developing and the land was a lot more value. So as terms of the notes, remember, they split the equity 50-50. So if we're just using round numbers, they split about $80,000 50-50 at closing. So let's back up for a second. How'd the Roth IRA do? Roth IRA put up $50,000, got 6% over 7 years, and got $80,000 or split $80,000 when the property was sold. How'd the Roth do? I think good. Completely tax-free, by the way. Okay. How'd the borrower do? Some people say, well, he gave up too much equity. I would argue he came in with $0. He paid 0 for 7 years and walked away with $40,000. If that was how every one of your deals was structured, real estate investors, how many of those deals would you do? If you put nothing in it and had to pay nothing for it and walked away with 40 grand, you would do every single deal you could find like that. So this is an example where they were going to walk away from this deal. Okay. There was no deal at 12% and 2 points, but they structured it in a way where it's a win-win situation and it worked out really well. One caveat to this, I will tell you, just because you're the lender and you're in the equity piece does not mean you're an owner. Yeah. I just want to make that straight. You don't get to dictate when the property's sold. If you've got a good relationship with your borrower, maybe you've got some influence there, but you can't make decisions as if you're the owner. You're still the lender. So you don't want to do these structured deals with people you're not comfortable with. I will tell you, don't structure a shared appreciation note with somebody you meet for the first time at a RIA. You don't know if you want to be married to them for 7 years. But if it's somebody that you know, you trust, and it just works well to structure the deal like that, and you're not worried about cashing out early or something like that, because they could get messy if you try to, get out of the deal before it's actually closed, then these deals can work really great. So, and it can also exceed, what you would make in interest. He made a lot more money than he would have made just charging the 12% interest. And the borrower was happy because he got a deal under his belt that he wouldn't have got otherwise through traditional financing. So that's a shared appreciation note. I hope this helped you guys understand how to be a lender with your self-directed IRA. I hope it gave you guys at least some things to think about. Even for you borrowers out there, understanding how to create win-win scenarios. If you break it down real simply, IRAs make up $12 trillion of American wealth. Retirement accounts as a whole make up 35 trillion of American wealth. It's one of the biggest sources, if not the biggest source, of private capital in our country, yet it's the one that's least used. Most people just go to banks, most people go to hard money lenders, and there's nothing wrong with going to those people. But if you've got money in an IRA, what's it doing? Is it invested in stocks or invested in things that you're just not performing well, that you're not happy with? Does it make sense to turn your IRA into a bank and create that income stream? And this is good for people who are looking to retire through an income stream. There's different investments that give you, cash payments. I understand that, but one of the great ways to have an income stream in retirement is to have assets in your retirement account that produce income streams, right? Rental property creates income streams through rents, monthly basis. Notes also create income streams through the monthly payments if you structure them right. And if you look at banks today, what are banks in the business to do? loan, don't own. And banks do pretty well putting their money out there and just sitting back and collecting interest. So this is why you see it very common in the IRA world, especially self-directed IRA world, why a lot of people like to be lenders, for the income streams. If they do it right, their money's secured by something tangible, which is the property. There's also a lot of social benefits too that I didn't touch on that happen when you make a loan to a real estate investor. You're helping a real estate investor take an eyesore out of the neighborhood and turn it into a pretty home, right? Take an ugly home and make it pretty. But they're also doing other things too with your money that I want to make sure that you guys get, is that they're also in the process of rehabbing that property. That real estate investor is hiring contractors who are hiring subcontractors. So your money's putting people to work. Those people are putting money into local businesses, local lumber stores, Lowe's, Home Depot, and it's all being done with your money. So there's a social benefit too with your investments that oftentimes gets missed when we're just being an investor thinking about how much money am I going to make. Also ask yourself the question, what else is your money doing, to better our community? Is it just invested in a nameless mutual fund, or is it invested into a property that needs a little bit of tender loving care, and it can be done with your money and you put people to work at the same time? And at the end of the day, once the property is rehabbed with your money, then it's sold to a family looking for the American dream of home ownership. So there's a lot of intangibles there that we don't often talk about that I think are important. But that's why I like being a lender. And that's why I think a lot of people like being a lender. No work, no toilets, no tenants, but definitely some considerations that you need to make before you do it. It's not a risk-free investment. There is no risk-free investment, but if you do it right and you take heed to some of the considerations I mentioned, I think you'll be good in the long run. So I'll get off my soapbox there and wrap it up and then take some questions too. So want to remind people, stay up to date with Nuview. Connect with us on Facebook if you haven't. Follow us on Facebook so you get notifications of when we go live. We've got an Instagram channel. We've got a YouTube channel that we're posting new content up all the time, and our LinkedIn as well. And before I get to the next stuff, let me see if I have questions. Do I have questions, guys? Don't be afraid to speak. There we go. All right. Sorry, I can't find my mouse here. All right, here we go. So is the IRR in case study 2 equal to 13.56%? I'm not sure what, I think you're talking about the 2 points and 12%. That's actually would be 14%. So again, double digit returns is kind of, I think, where most people are. And actually, that's a good question that you bring up, because I want to mention something real quick. When you're talking about private money, oftentimes people say, well, what are the average rates for private money? So private money loans, okay, IRAs are just money in your bank account. Okay, if you're going to loan that money out, that's considered private money. Where are most interest rates at? Probably between 7 and 12%. Now, why is it 7 and 12%? Well, just think about it. Conventional banks charge 4 or 5%, but if it's a little bit more, if it's an investment property. But what's a traditional bank also going to do? They've got an underwriting process. If it's investment property, they want 30% down. They want tax returns. They want your W-2s. They want your blood sample, your firstborn. And then once you give all that, then they might approve your loan in 30 to 45 days. And that's good, but that doesn't really work for most real estate investors that are trying to wheel and deal and make cash offers. So other people go to hard money lenders, and there's nothing wrong with hard money lenders, but realize hard money lenders are going to charge the maximum interest rate, and that's usually about 18% in the combination of fees and points. So private money is right smack dab in the middle. Okay, private money is right between that 7 and 12% sweet spot. And I will tell you, big hedge funds on Wall Street have already got keen to this. There's big hedge funds that have already set up large funds that have been loaning money in that private, because there's so much need for that private money space. So typically you're going to find most of your IRA or private money loans between 7 and 12%. But if you're the lender, you choose what you want to have as your interest. If you're in retirement, I've seen a lot of people just be happy with 5%. It's way better than a CD, and it's secured by real estate. So again, it's really up to you. And I would always just say, charge what makes a win-win situation. You don't want to charge too much to where your borrower can't perform. That's something you want to think about, but you want to charge enough to makes you happy with the deal, right? So I would say anywhere between that 8 and 12% is usually where I see most loans. I typically do mine at 12, 2 points and 10%, or 2 and 12. Let's see, Brad, can my IRAs LLC lend as first lien position while I lend from a non-IRA LLC as a second lien position? So great question. Unfortunately, you can't do that because that would be considered an investment that's not parallel. Okay. So if you're ever doing an investment with your IRA, whether it's in an IRA LLC or just the IRA itself, and then you've got something personal, your LLC or you personally, any investment that you go in together on has to be done as a parallel transaction, meaning if we go into and do a first lien mortgage, both of us have to be partnered on that first lien mortgage. If there's going to be a second lien mortgage that we're both going to be a part of, we both have to be a part of that second lien mortgage at the same percentages. You don't see that very often, but it would not be a parallel transaction to have, say, your LLC, your personal LLC have the first lien mortgage, and then you, your IRA have the second lien mortgage. It would be a conflict of interest because obviously you've got two different liens. Obviously, the first lien supersedes the second lien. So you're putting yourself at a conflict of interest with your IRA if you personally have one lien and your IRA has another lien. Great question, though. Let's see. Michael asks, a pledge of the LLC plus the mortgage and the loan would be stronger way to invest. I'm not really sure what that question is. Maybe you can email us and my question does not fall under 1940s Act. Give us a call. I'm not sure what the question is there, Michael. So I'm just trying to read through here. Yes, Michael, the IRR is 14%. That is not very attractive versus 12% and 2 points. Again, it's all about what your investments are doing. Here's one thing that I'll mention too is if you're a borrower too, if you are looking for private capital, one thing you want to start that dialogue with people of, what's your retirement doing? Okay. If you are running into people at RIAs that have maybe changed jobs or they've got investments or they're investing in things that are very conservative, I always say a CD, for example, certificate of depression, I like to call it. Well, if you know somebody's making 1% in a CD, how much of a life-changing event is giving them 5% or 6%? And maybe that person doesn't need 8%, or maybe you're just somebody that's in a CD that would make them like to make, more of a return. So when it comes to interest, it's all about what you're comfortable with, right? Obviously, everybody is at a different stage of life as well. So to you borrowers, understand that different people in different stages of life will want something different. If you're talking to somebody that's a lot younger, that's got an IRA that might be potentially your lender, they might want more. They might want more of the risk. Maybe they do something more like a joint venture or a shared appreciation loan. Who knows? But if you're talking to somebody who's older, who's past retirement age, they're not looking for home runs. They just want safety, security. So your conversation with that person is probably more to, how am I going to keep your money safe? Here's what happens in the event that I die. How do you get the property back? And they might be willing to loan at 5%. So, but if you're getting double-digit returns, I will tell you, if you're getting double-digit returns year after year and you're able to compound the interest, I will tell you that there's some magic that happens, especially if you're doing it in accounts that are tax-free, like a Roth IRA, an HSA, ESA, or a Roth 401k. Let's see, Krista, can I provide a loan from my self-directed IRA to help a buyer purchase a property that I personally own? Guessing no, you would guess right. Yeah, so you can't make a loan from your IRA to any investment that is owned by you personally, because again, you're creating a personal benefit through that transaction. All your loans at your IRA have to be to non-disqualified people to property that are not owned by you personally or any disqualified people. Let's see, can I provide, oh, that was the same question. When it says interest 8 to 12%, is that the same as annual interest rate of return? Yes, that would be annual rate of return. So if you're charging 12%, it's basically 1% a month. You can look at it that way. So, and depending on how the deals are structured, there's different, ways that you can structure how the interest is paid. Some people have a flat interest where it's 12% annually. So if the loan's paid off early, then you still get the 12%. But most loans are going to be amortized and the payments are going to be spread out over 12 months. So if we're talking 12% spread out annual interest, it's technically 1% a month. So good question there. All right. Any other questions? I got thank you. It doesn't look like we got any other questions. So I appreciate all your guys' attendance. I hope this was helpful to you guys. I will get on. I got a couple last announcements here, especially for you people who are in Florida. If you guys are interested in getting back to live classes, we are starting our live classes back here in Longwood at our office here on Ronald Reagan Boulevard. And we're going to do it every month. It's going to be the first Thursday, or sorry, the third Thursday of every month. So it's going to start in September. September 16th is our first live class, and we'll do it monthly every third Thursday. This is a great opportunity not only to learn about different strategies with self-directed IRAs, but also to network with real estate investors. I get this question almost every day. Nate, how do I find deals? How do I meet other investors? You can meet them at local RIAs, and you can meet local investors at our local classes, which are back, and they're going to be better than ever. So September 16th is going to be our first class. We're going to start at 6 o'clock is when networking starts. So we'll network from 6 to 6:30. We'll have food here. We'll have drinks for you guys. It is completely free to attend. We will be streaming it live for anybody that's outside of the area. But if you're in the area, you get so much more benefit by coming to the class and actually engaging, asking your questions, and also engaging and networking with the people that attend, which a lot of them are actually Nuview clients. So that's going to be how to make big bucks in small accounts is going to be our first class, and that's going to be September 16th at 6 p.m. Go to our website, register, or click that QR code there and get registered so we know that you're coming. But we're very excited to bring our live classes back starting in September. And then I also want to mention that we do have a promo. It's the end of summer. I know it still feels like it's hot and humid here in Florida, but we are extending a little bit of a promo, a little bit of love for you guys. If you're looking to establish your own self-directed IRAs, whether that's Roth IRAs, HSAs, SEP IRAs, a lot of people who are self-employed, you might be looking at your CPA is probably telling you to set up accounts or make contributions. You can make contributions to a Nuview IRA, just like you can make contributions to a Fidelity IRA. So if you need to set up SEP IRAs or simple IRAs, your employer plans before the deadline's coming up, we can do that for you. And we've got a promo to where if you pay one application fee of just $50, we'll waive all the application fees on all your accounts going forward. And that includes brothers and sisters and other people that you bring. So pay $150 application fee and get as many accounts as you want. So if you want account for yourself, your spouse, your kids, health savings accounts, all that stuff, it's a great time to do that. And I will just say, if you are interested in taking part of that promo, just email us at IRA specialists at nuviewtrust.com. That's IRA specialists with an S at nuviewtrust.com. Just tell them I want multiple accounts, and one of my IRA specialists will get back to you ASAP. Make sure to leave your phone number as well so we can reach you. So thank you guys. I appreciate your time. I'll see you guys next Wednesday on our Wednesday workshop.